Welcome to the BNB Investing Podcast for real estate investors. Fix and flippers and realtors exploring investment options with Airbnbs and short-term rentals through acquisition, leasing, or management to generate consistent monthly revenue. Join us for a chat with experienced and successful short-term rental investors to hear their story of how they got started and created wealth by building scalable businesses. We also explore various service providers and lenders that help make our businesses more efficient and maximize revenue in this awesome sharing economy. Welcome your host, Rich Monroe.
Hey everybody, Rich Monroe here on BNB Investing Group. Thanks a bunch for jumping on with us this week. This week we've got a good friend of mine, Mark Welch, and we're going to walk through some of the stuff that we're all dealing with when we're looking at buying properties for short-term rentals. And so BNB Investing Group is a group of members that are looking at short-term rentals and figuring out the different nuances. There's three different ways we can make money with short-term rentals. We can either lease properties and do short-term rentals with it. We can buy them through acquisitions, or we can manage other people's properties. And so obviously we're going to focus a little bit more on the acquisitions piece for this week. And I know historically we've been having a lot of my other friends on here that are short-term rental operators. And so Mark has the pleasure of being our first lender. I'm going to have a couple different lenders that we'll invite, and just to get a couple of different perspectives and see what the financing options are out there. And so if you're just jumping on, if you wouldn't mind, if you could just throw a yes in the comments section to confirm that you're able to hear me, and we will go ahead and get started. And Mark, thanks a lot, buddy, for jumping on. I know you're having an issue with your camera there, so I'll let you do your brief introduction, and we'll definitely get started. And again, those of you joining, feel free to put any questions in the comments as well as we walk through this with Mark.
Hey, thanks, man. Happy Thursday, everyone. I am Mark Welch with KRAM Capital Group. We are a nationwide commercial brokerage, but we also specialize in short-term rentals, better known to a lot of people as Airbnb or vacation rentals. So we arrange financing from Alaska to Hawaii. So we pretty much cover most states except for Nevada, and a few other states that we don't cover, but Nevada for short, North and South Dakota.
All right, and so Airbnb financing and lending to people that are buying short-term rentals, that's something that you guys, I think it's been a while now that you have a specific category that you service for people that are buying short-term rentals, correct?
Yes, we began this journey in 2018, focusing on the short-term rental Airbnb vacation rental space. At the time, financing wasn't as popular as it is now, but still it's an evolving space. Back then, we were using market rent, 90% of market rent for those who were purchasing or refinancing.
Mark, if you could get a little bit closer to your mic, we're having a hard time hearing you.
Can you hear me better?
Yeah, that's better.
So I was saying back then, we would use market rent to qualify the acquisition or the refinance. So we'll use 90% of market rent to qualify the property. But now there are dedicated programs that strictly for short-term rentals, vacation rentals.
And so are you still looking at 90% of the market rent as a qualifier?
No, what we do now, you have a couple of ways to look at income. Number one, if the property is currently used as a short-term rental, and we can use, when we order the appraiser, we'll order a 1007 report. And basically what a 1007 report is, that's an income report that the appraiser will look at similar short-term rentals based on size, accommodation, number of bedrooms, and see what their nightly rates are, and then they'll come up with a monthly market rent or market income for subject property. Or we can go to AirDNA, which is a third-party source, data source, that would give you an idea what are the nightly rates, the occupancy percentage for that property as pertained to the similar properties in the market. Or if the property is active and it's a refinance, we can use 6 or more months of income. So whenever your property is on a platform, whether it be Airbnb, VRBO, bookings, they give you your monthly ledger based on the number of guests that you have and your income and expenses. So we'll use that data as well to calculate the debt service. And the fourth option would be just to use market rent. So if a market rent is strong enough, when I say market rent, I'm referring to if you have a lease agreement in place. So there's a contract in place with someone for 6 to 12 months. So we can use those numbers if it's strong enough to meet 1% or 100 on the debt service. So it makes it much easier.
So if you wouldn't mind, if you could scroll a little bit down on your website to where it talks about qualifying for short-term rental financing. I think it's a little bit further down from the shot that you're showing now.
Let me bring it up here. Is that better?
Yeah, keep going down. I want to go down to where you have the qualifying
Right here?
for your short-term rental.
Here?
There you go. Perfect.
Okay.
So go ahead. You can walk us through this.
So if you want to get 75% or above on a purchase transaction, between 680 and 700 and 720, we're at 75% LTV. 720 and above, we can do 80% on the purchase. That's on single family, townhomes, condos, duplex or 2-unit, 3-unit, 4-unit properties. But if you're doing a condo, a non-workable condo, there's a reduction in LTV for that. So typically at 680, you'll be somewhere between around 70% LTV on a non-workable condo. And there's also a reduction for condo sales as well.
All right, we're still having a hard time hearing you, Mark. I'm not sure if you just need to move closer to the mic or not.
How about now?
That's a little bit better. So let me ask you a couple questions. So, I'm an investor. I already have a mortgage on my primary residence, and I'm about to buy my first property to do short-term rentals. And I can come to you, and the qualification is, the FICO score is going to drive how much money I need to put down. And you have to be at a minimum of 680. The higher the FICO score, the less money you have to put down. Is that correct?
Well, yes. So the best case scenario, put down 20%.
20%, you said?
Yes. Best case scenario.
Okay, so you can't get it any better than having to required to put down at least 20%.
At least 20%.
Okay. All right. And then as far as the income qualifications, you're able to use the revenue generated from that property as income to qualify you for the loan, correct?
Yes. So I can cover 2 of those for you right now. We use investors' credit to qualify for the loan, but those loans are not reported to your credit bureau. These loans are considered business purpose. And so when it's reported to your credit, they consider it consumer debt, and on these transactions, it's a business purpose loan. So you don't have to worry about the trade line impacting your debt service. As it pertains to income, we use the actual income or the projected income of the property to qualify.
And then obviously the more income, the higher purchase amount, as long as I'm able to keep up with the 20% down payment requirement.
And meet debt service. That's important.
and the debt service. So the debt service would be limited to the expenses incurred on that property in particular, or all of my debt?
It's only on the subject property,
Okay.
and the debt service on the business purpose side, it's different. Debt service is used mostly on true commercial assets, but it's not being used in this case. And it's the watered down version or the Cliff Note version of it. So all we do, we take the annual PITI or PITIA. The A is if the property has an association fee. And then we divide that into the net annual income of the property.
Okay.
And that needs to be 1.0 or greater.
So walk us through an example with numbers so we can just clearly understand that. And we're still having a hard time hearing you too. I'm not sure if it's your mic, or I don't know if you have the ability to change your mic.
I'm speaking directly.
If you go to your the settings again.
Can you hear me better?
Yeah, but we hear you better for that second, and then it goes back to being kind of muddled.
I don't know why. How about now?
That's a little bit better.
Okay.
That's much better, actually.
I will give you an example.
Okay.
So say your annual income on the property is $1,100. So the annual net operating income is $1,100, and your debt on the property is $1,000. So you divide the 1,000 into the 1,100, and that goes 1.1 times. So if you convert it over to the actual number, you only need to be at 1.0 to qualify.
Okay, so obviously the higher the income, the better off you are, right? So if you've got 3,000 in income coming in, then that helps the ratio.
Yeah. So for instance, what the debt service tells you is this. So if you're at 1.0, it's telling you you're breaking even. So the money that you have coming in, plus what you're paying in PITIA, you're bringing enough income to meet your debt service and nothing above. But if they're 1.2, after you meet debt service, you still have a 25% left over. If you're at 1.5, after you meet your debt service, you have a 0.5% of the income left over, 50% of it left over.
Okay. And then does that the barometer of that going up and down, does that help me at all on the interest rate or any other terms of the loan?
I know it doesn't help on the interest rate to go up, but say if your debt service is less than 1%, we can typically go down to 0.75, but then you'll take a bump to the rate. There'll be a rate increase for that going with the lower debt service. And just for clarity, when doing short-term rentals, typically the income is 1.5 to 3 times greater than traditional long-term rent. So if you're using the projected income and you're only getting 1.0, that may not be a good deal because the income is not strong.
I got you. And to recap what you said earlier, so if I'm buying this property, I haven't ran it as a short-term rental yet, but I'm acquiring it to do so, then you guys are going to typically look at AirDNA to kind of determine what the average nightly rate and the occupancy levels are for that particular property in that area.
Well, AirDNA is one of the financing options we can look at. So our first option would be to look at what the actual income for similar short-term rentals are in the area. So when we order the appraisal, we would ask the appraiser to do a short-term rental valuation based on other short-term rentals within that submarket.
Really? Okay. I didn't realize all appraisals have that ability, or just some?
Not all of them, because it just depends on the location. Like areas like Kissimmee, Florida, and other high-density areas for short-term rentals, you have more appraisers who are accustomed to doing those types of evaluations, but it's becoming a common practice, but it's still a slow transition.
And what do you know? What kind of platforms or tools the appraisers are using to determine the historical revenue on short-term rental?
I don't know what they're using. They may be reaching out to property management companies, such as Vipasa or Evolve or other local property management like you guys.
Okay. All right. And so you do that. What if I already have like history and a track record in that same area that for that property that I'm buying? Are you able to use that historical data on my other properties?
On a purchase transaction, I can use it on a case-by-case basis. If it's a refinance, I can definitely use it. And one of the concerns with on a purchase transaction is that in this space, operators, how you operate your property is very unique from your marketing and your management style and your customer service. So the selling party may have been really great at marketing and maintaining the property, but the person coming in may be new to the market and may not have the same understanding. So using their previous income to project the sale may not be accurate moving forward. So, and sometimes it's better just to go with the projected income than the actual income on a purchase transaction. But it's on a case-by-case basis based on the strength of the investment.
Okay. And let's take a step back for a minute and talk to us about the advantages of engaging with a firm like yourselves, because you're not really a bank and just lending your own money. You're kind of dealing with a network of other. I think you guys have your own fund as well. But walk us through the advantage of partnering with someone like you to do an acquisition.
Well, for one, we have been in the space since 2018, from the very beginning. And we try to stay abreast on the changes that are taking place as it pertains to the loan products. And our main focus is to understand the need of the client, the customer, and then we're aligning with the product that is best suited for what you're trying to accomplish. So our goal is to not only do one deal with you, but to help you grow your portfolio, to go from being a small operator to being a major player within the short-term rental business.
So is there a cap on how many loans I can do or how many properties I can do as an investor?
Kind of, this depends. So if you're doing a blanket loan, say you're buying 50 short-term rental properties that are currently active short-term rentals. It could be single-family condominiums, townhomes, or it could even be an apartment complex. If you're doing an apartment complex, we'll prefer to have all of the units are functioning as short-term rentals. So it can't be fractured having 50-50. So it needs to be close to 100% occupancy or usage as short-term rental when you're dealing with apartment. If you're going to be buying the properties one-off, typically I can go up to $10 million in property for one operator.
10 million for one operator. Okay, that's interesting. So back up a second on the multifamily comment. So if I've got a 50-unit building that I'm either refinancing or acquiring, your preference is that that all of those units are being done as short-term rentals?
Yes. So if they're all if the primary usage of the complex short-term rental, then we can underwrite that with 1 year of proven income.
What if the regulatory environment, for example, we're working right now with the city of Atlanta on rewriting the ordinance, and one of the things that's being tossed around is a cap on how many short-term rentals you can do in a multifamily building of like 33%. You can't exceed 33%. What if there's a regulatory requirement that limits you to the number that you can do?
Well, we won't be able to do it because if it's only 33%, the guidelines right now request that we have at least 100% usage. I will not be able to do it as a short-term rental.
All right, so that begs the next question, just so that we have clarity around this. the looking at it this through the lens of financing for an Airbnb or short-term rental, what's the advantage of going this route versus just doing it as a long-term traditional rental as far as the income goes? Is there a huge upside for us to finance it as an Airbnb specifically?
Well, it just depends on your strategy. So if you're doing it as a business and you want to have your entity be the owner on title, then doing it as a business purpose loan and not having it on your personal credit and having it as a debt, those are the two advantages. So, but if you're a person, this is your first acquisition, and you're buying a two-tenant property, you're going to occupy one side, what we call it now house hacking.
Yeah.
And if you're doing a house hack, then going traditional may be the best option coming out the gate because you get a higher leverage on financing, and now you can kill two birds with one stone. And so now when you get to your third acquisition, then you can come and do it from the business purpose side instead of going back traditional. Because when you're doing the traditional, I think you have to show reserve for all the units that you have ownership of.
And then traditional, you're obviously getting a better interest rate and potentially less down payment requirement as well.
Yeah, but now interest rates are pretty much similar across the board. The prime lending rate now is 8%, and I'm underwriting loans at low sevens, mid sevens on up. So we're pretty much in the same ballpark.
Yeah, and that's for a 30-year term?
That's a 30-year fixed, 30-year AM with a 5-year prepayment penalty.
Okay. What is your from what you're seeing in the lending world, what are you seeing with the interest rates? Are we still kind of going to be at this level for some time, or are you seeing any, what are your thoughts about that?
Well, I've always had an opinion when dealing with investors. Don't focus on rate, focus on your return on investment. So if your cost of money is 8%, and you're getting a 30% return, gross return on your money, by the time you back out your operating expense, you may be at 15, 16% return. That makes sense all day twice on Sundays.
Yeah.
So if you're buying a property to live in where you're not going to make a profit on it, then your cost of money should be a huge concern. So look at what you're trying to accomplish. For example, if you're doing a refund, say you have a property and you have debt of $250, but that property is now worth $1 million, and you're generating say $6,000 a month on that property, and you want to pull out $500,000 to acquire a $2 million multifamily that's going to give you $400,000 a year. Paying 8% for that money makes sense based on the increased return that you're getting. They're all relative to your strategies.
Got it. That makes sense. Now, is there like a general average return that you guys look for when you're evaluating a short-term rental opportunity, or are you leaving that up to the investor to decide?
That's on the investors. The only thing we look for is make sure you meet the minimum debt service coverage for that particular product. That's it. And usually that's going to be 1.
Got it. Okay. So if we wanted to apply for this loan and, we're in the market and looking for opportunities, are you guys doing anything with folks that are doing rehabs as well? Or are you specifically looking at, kind of retail purchases?
Good question. So the rehab program would be if you're rehabbing a property to sell it, or in this case, I'm just going to assume they're rehabbing the property to convert it after renovation into a short-term rental. So more like the BRRRR method: buy, renovate, rent, refinance, repeat. So in that, you can take out one of the R's, because in order for us to refinance it, the property doesn't have to be occupied, or it doesn't have to be on a short-term rental platform. We can still refinance it being vacant, but it will be 2 separate loans. We have a renovation loan, and then you have to refinance into a long-term loan.
Got it.
So, but when doing that, be careful to make sure that on the takeout, the loan amount and what the market is allowing, what is market rent, traditional market rent, or short-term rental rent, is sufficient to cover the debt service that you have on the property, the debt that you're gonna have on the property, so you can meet that service. I have an example. Someone called us, and they have a property somewhere here in Atlanta. They owe about six and some change on the property, about 675, and the property probably worth close to $1 million. But the market rent is only like $4,000. And then if you go to AirDNA, it says the occupancy for short-term rental is only 20%.
Mark, hold on one second. I think we have a problem with the live broadcast. I think Facebook popped us off of there. Just a second.
Okay.
All right, let me see. I might have to. Yeah, it's giving me an error message on this side. Let me see. I might have to end the broadcast and restart it, which means I'll have to send you another link. We only got about 15, 20 minutes left, but I do want to finish up. So let me send you another link real quick, and then we'll jump back in.
Okay.
All right, thanks, Mark.
Thanks for jumping on the BNB Investing Podcast this week. Please click on the subscribe and like button below. For more trainings, property tours, and content, you can join my BNB Investing Facebook group by clicking below. If you are ready to grow your short-term rental portfolio and maximize your monthly income, you can click on the link below to schedule a quick strategy call with Rich or someone from his team to see how we can help or point you in the right direction. Stay tuned for our next episode and hope to see you on the BNB Investing Group podcast.